Good afternoon everybody, I trust that you are well. The aim of this video is to explain to you in layman's terms what is the Investec Environmental World Index Autocall all about. Before we go into detail, all of you would have seen this slide before. I want to go back to basics. Whenever you analyze any investment to ascertain whether it's worth investing in, you break it down in terms of these four components. What are the fees? How much risk am I taking relative to the potential return that I can receive, and what are the tax implications? So the long story short is all the fees is built into the product. So all the returns that we're going to discuss today that I'm going to show you will be net of fees. The risks, there are two risks to this investment. One is that the shares that you invest in, the basket of shares called the index, can be lower in 5 years time. As long as it's not more than 40% lower, you will get your money back. But if the shares drop by more than 40% over a 5-year period, there's a risk of losing your capital. The other risk is the risk that you will be taking on Goldman Sachs, which is a very big international bank, and you take senior debt risk. We'll unpack that a little bit later. Senior debt risk being bonds, so not equity risk, not as high as equity risk. The potential return is 25% per annum if the basket of shares is level or flat or positive in 3 years time. It only has to be up 0.1, 1, 2, 3, doesn't matter by what percentage. As long as it's positive, you get a 25% return per annum. And then from a tax perspective, capital gains tax will be applicable in year 3 if this investment comes to an end. The same if it comes to an end in year 4 or year 5. Whenever it comes to an end, capital gains tax will be applicable. So if we have a look at the Investec marketing material, I'm not going to go through all the slides. There's 20 slides and there's more than one brochure. I'm just going to very briefly go through it. This is a high-level summary or overview. You're welcome to ask me some detailed questions. You can email me or you can give me a phone call and we can discuss it in greater detail. So Investec has put this index together, which basically consists out of the 40 greenest companies currently in the world. So they measure these companies according to ESG metrics. ESG stands for environmental, social and governance, and these are central factors in measuring the sustainability and social impact of an investment in a company or a business. You can see last year the flows to these types of companies have increased significantly. Last year alone, more than $20 billion went into sustainable companies or sustainable funds. So it's a 5-year product with the call date that can either be in year 3 or year 4. So minimum 3 years, maximum 5 years investment, 25% return per annum. Your credit risk is with Goldman Sachs. Whilst we're on that point, I can just quickly show you something that I've put together. If we have a look at Goldman Sachs and the market cap of Goldman Sachs, it's sitting at $66.6 billion. Converted to rand, it's about just over R1 trillion. So the market cap being the number of shares times the market value. This is as at yesterday, and you will note that Goldman Sachs is bigger than all 5 South African banks combined. So a very, very big bank. And then from a credit rating perspective, you'll see I got Moody's, Fitch and S&P's ratings here, as well as a table as to how to interpret the ratings. I've circled it in red for you, and all 3 rating agencies rating Goldman Sachs as investment grade when it comes to their credit risk. The other thing that we must take into account is where do we sit in the hierarchy with regards to the debt that we own in Goldman Sachs when it comes to potentially losing our money. So this is the capital structure of any bank, and it's ranked from the lowest risk being the creditors, then in deposit holders, senior debt holders, subordinate debt holders, preference shareholders, and ordinary shareholders. So typically when you buy a listed share on any exchange, you own the ordinary shares, meaning that if something goes wrong, you are the first one to take a haircut. So what is the likelihood of anybody investing in this product losing money when it comes to the credit reference entity being Goldman Sachs? So if we look at it, basically all the ordinary share capital of more than R1 trillion has to be written down to zero before the preference shareholders would have to write down everything to zero, before the subordinate debt holders would have to write everything down to zero, before we would stand a chance of losing any money, as we will be having senior debt exposure. So a very, very low risk investment, one notch higher than placing a deposit with Goldman Sachs, and then from a credit rating agency point of view, safer than any of the cash that you currently have with any of the local banks. Let me just, sorry for jumping around, let me just find it. Okay, so you've got 100% capital protection provided the index doesn't fall more than 40%. So in other words, if you put in 100 Rand, or the minimum is 100,000, if you put in 100,000 Rand and the index falls 50% at the end of year 5, you will get 50% back. If the index falls 39.9% or 99%, you will get your full 100,000 back. So it's only if the loss is greater than 40% do you have the potential of losing any money. Then this is an auto call, meaning that it can call automatically in year 3 or year 4 if the index are up or positive. So you don't have to phone me, or I don't have to phone anybody to say I want to sell out now, or please give me my cash. The investment will automatically come to an end if the basket of the 40 shares is flat or positive at the end of year 3. There's actually a nice graph that explains it, and I'm going to jump straight to that. So there's 4 typical scenarios. You buy the index and the initial level, let's just call it as 100, and it basically goes up, and in 3 years time it's greater than 100, and that's why you get your capital, whatever you invested, plus 3 times the enhanced return, 3 times 25, in other words a 75% return. Another scenario would be that the index goes up, but on the date that they actually measure the investment in 3 years time, the initial index or the index is lower than the initial index level, which will mean that it will basically run for another year. On the 4th anniversary, you can see the index is still below, which means it will carry on for another year. It can't carry on for longer than 5 years. At the end of 5 years, one of these 3 outcomes is going to materialize. So in this particular scenario, the index ends higher than the initial index level in year 5, meaning that the capital will be paid out plus 125% return, 5 times 25. Another scenario would be that the index grows positive, but it just keeps on falling on all the anniversary dates, and it actually ends up breaching the barrier of minus 40, meaning that at the end of the term, the basket is down more than 40%, which will then result in a loss, as I've just explained earlier with the minus 50 or the minus 60%, you actually lose that money. The last scenario, the green one, is where it actually dips below the barrier, but it then recovers. And just note that whether it breaches the barrier at any stage doesn't matter, as long as it ends more than or less than 40 down, you basically get your capital back. So if it's minus 10, minus 20, minus 30, minus 40, you get whatever you invested on day one, you get back. Just also keep in mind that this is the nature of any naked equity that you invest in. If we invest in listed shares or a unit trust that's linked to global equities and markets fall, you generally have zero downside protection, so you will always get whatever the underlying asset has yielded. In this case, you have a 40% downside protection. I want to just quickly go through my record of advice, just to show you as to why I said that this is a good investment currently. So you can invest in 40 well diversified multinational companies, and the combined market cap of these companies is $5.85 trillion, converted to rand as of yesterday, 93.6 trillion rands. So if we just have a look at that, what I've done is I've listed the 40 companies in this index, from the largest to the smallest, and basically just expressed whether it was listed in the UK or the EU. I've converted that to a dollar figure just so that we have one currency. So you can see what I said there is the combined market cap of these companies is $5.85 trillion, which is 93.6 trillion rands. If we compare that to the JSE Top 40, the combined market cap is sitting at 10.5 trillion rand. So, these 40 companies are almost 9 times as big as the JSE Top 40. So, yeah, very big, solid multinational companies. Okay, then I just said that the appetite for these ESG ETF products have grown considerably amongst institutional and retail investors. The whole world is looking at companies that is looking after the environment, that's looking after its people. So we can only, see that increasing in the future. And when we look at this investment from a risk versus a return perspective, a 25% return is a significant return, considering that we only take senior debt risk and not equity risk, as per Annex B, which I have basically explained already. And then another thing is, if you have a look at the Investec marketing material, they did back testing on this index to ascertain, statistically, what percentage chance is it that it will end up, in other words, that you're going to receive the 25% coupon. And the stats are as follows. There's a 76.8% probability that the index will be flat or positive in either 3, 4 or 5 years time, in other words, that you will get the 25% coupon per annum. And 23.2% of the time it will actually be between minus 0.1 and a minus 40. In other words, you will get your money back. And 0% of the time it actually resulted in somebody losing or taking a haircut. Just note that this was done by the time the marketing material was released, which was end of January, beginning February. And at that stage, the most that this index would have fallen over any 5-year rolling period was minus 34. Hence, they've put the barrier in at minus 40. But the status quo has changed slightly. As you know, global markets have experienced a correction over the last week and a half, or the last 2 weeks now. And now is actually a very good time to invest, because this index is now 23.3% lower than it was on the 10th of February. So technically, one now has 63.3% downside protection, because we will be buying in here, which is very low. So from this level, it only needs to be level up in 3 years' time in order to get the 25% per annum. Then I've just put a note in here to say that you are as a client that will be investing in this, comfortable with Investec, and you are also comfortable with Goldman Sachs senior debt credit risk. I've put Investec in there as they are the issuer of the note, but the credit risk is sitting with Goldman Sachs. And I said Annex B, which is the one that I have covered, which has got Investec's credit ratings on here as well. So if we look at the returns, some of you have asked me, so what is my after-tax return? So one has to look at what is your marginal tax rate in order to determine what your after-tax rate. So I'm just going to use the 45% as your marginal tax rate. Most of you are on 45%. In other words, if you receive a 25% return, you're going to pay capital gains tax of about 4.5% which means the net gain after tax, after fees, will be 20.5% per annum. So I've basically just illustrated this by using 3 scenarios. If the product matures in year 3, if it matures in year 4, and if it matures in year 5, what can you expect? Since the probability is the greatest that it's going to pay out in year 3, let's look at this one. So if you put in R1,000,000 in 3 years time, if it's flat or positive, you will get your million plus additional 750,000. You will get a 40,000 Rand off as your capital gains tax exemption that you annually receive from SARS, which means that an amount of 710,000 Rand is taxable, which basically means that 40% of this amount you must include in your tax return, on which you're going to pay 45% tax. So the effective rate is 18%, which is the 127. So after tax, after fees, you're looking at about 622,000 Rand growth that you can expect to receive in 3 years time, and this equates back to the 20.5% that I've put on top there. Sorry, just excuse me. Then I just want to have a look at some of the other annexures that I prepared. Annexure A is basically where I summarized all the Investec material in a one-pager. I know most of you like a one-pager. I've already explained the downside protection, the index that is linked to the term between 3 and 5 years. The growth is linked to the 40 companies. The nominal return per annum, the tax that has to come off there, your credit counterparty risk, Investec, Goldman Sachs, which is one notch higher than placing a deposit with them. Minimum investment is 100,000. This is what we call a JSE inward listed note. In other words, you need a stockbroking account in order to buy this note. If you do not have a stockbroking account already, Carly or Annalay can assist you by opening a stockbroking account. You do have daily liquidity on this investment, but I recommend that you only invest funds that you do not require for the next 5 years in this investment. It's not something that you necessarily want to sell in year 1 or year 2, as the return is not going to be anywhere close to the 25% that you can get if you hang on at least for 3 years. The closing date is next week. If you want to invest, please contact me ASAP, and they're going to trade about a week after the closing date. I did include the same annexure for a company as well, just showing what is the effective tax rate if you want to invest via a company. If you invest via a trust, you will use the conduit pipe principle to channel any gains to the individuals, and then these same tax rates apply. If you invest by way of a trust and you do not wish to channel any gains to beneficiaries, then a flat capital gains tax rate of 36% will apply. Let me just see if I've missed something. No. So in a nutshell, very low risk relative to the potential return. All fees are built in, so all the figures that I've shown you are net of all fees, and from a tax perspective, a capital gains tax that will be payable either in year 3, 4, or 5. If you have any questions, please do not hesitate to contact me. Thanks everybody. Cheers. Bye.